Good morning, ladies and gentlemen. I see more than 100 participants having joined us already in this online session. Very warm welcome to today's event. I am Claudia Wessling, Director Communications and Publications at Mercator Institute for China Studies, and I will guide you through this session. Today we want to introduce you to a report that we just recently published together with colleagues and experts from our partner at Rhodium Group. It's a research that we've been doing for a couple of years now on Chinese foreign direct investment in Europe, and colleagues will introduce you to the 2022 update. The study is already available online. It has been published at the beginning of May, but today we will give you everything in a nutshell. And of course, colleagues will also be happy to answer your questions. Briefly introducing, Max Zenglein is with us today. He's Chief Economist at MERICS. Agatha Kratz is here, Director from Rhodium Group. Agatha, based in Paris. Welcome. And we also have one of the other researchers in the room, Gregor Sebastian, analyst at MERICS. He's our expert for, I will put it simply, everything automotive and EV in China. So if there's questions related to that field, Gregor will also be happy to answer your questions. So to briefly lead you into the topic, it is a super timely topic. You all see a lot of movement recently regarding China's economic and political relations to the world. The G7 has just published a declaration where China was really in the focus, saying, on the one hand, we need to reduce dependencies while at the same time maintaining stable and constructive relations. Ambitious plans. The numbers and figures on the economic relations and our report also shows a spotlight on a certain part. There is tendencies of exports going down. Germany has just released figures that exports to China have dropped significantly. Investments of China in Europe have also decreased. That's one of the main findings of the report we're going to introduce to you in a minute. There's a movement in greenfield investments, however. These have increased, especially in battery production. So China focuses its foreign direct investment more. And my colleagues here are going to explain to you why this is the case and what all these developments mean for Europe. I understand that Agatha is going to kick it off. Agatha, the floor is yours.
Excellent. Thank you so much, Claudia and MERICS colleague, for having me today. I'm excited to be presenting yet another iteration of this report. I think we've actually been doing this for 5 or 6 years now, so very much a long-standing exercise here. What we're going to do today is we're going to review the 2022 trends of Chinese investment in Europe, and we're going to go into a little bit of detail on the story around EV and battery manufacturing before giving you a little bit of a sense of the outlook for 2023. We're already well into 2023, but what we think will be kind of the end of your picture here. But before we do so, I want to start with putting those European numbers in context, because it can be useless or not as helpful to think about Chinese investment in Europe without having in mind what the global trend is. And here there are two main trends, really. The first one is that globally, M&A and outbound investment has been plateauing over the past few years. Part of it is COVID, but not just. There's been a movement to a slight financial, in particular deglobalization, a little bit of a slow curve, of course, amplified by COVID. We had a rebound in 2021, which is what you're seeing here as well. What you're seeing on the slide here is Chinese numbers, but China and Chinese outbound investment, as recorded by MOFCOM, followed that trend a little bit in 2021. But 2022 is back to a slightly plateauing, decelerating trend. And so what Claudia has been saying, which is that Chinese investment in Europe have declined in 2022, and we'll get to that in a minute, that has to be understood in the global context of declining FDI and declining M&A activity in 2022. Part of this, a lot of this due to global economic uncertainty, linked, of course, to the Ukraine war, but not just, and a little bit of a kind of a drop from the post-COVID rebound economic activity. that we had seen in 2020, but especially 2021. So 2022 is a little bit of a drop here. And in this context, we're seeing also Chinese kind of total global outbound investment declining from 152 billion in 2021 for the MOCOM numbers, which include M&A and greenfield in the whole of the world, to 117 billion. That's almost a decade low. We're getting back to 2014 numbers here. So a pretty low number for China's outbound investment, even including greenfield, even including other destinations than Europe or the US or advanced economy. If you look at the M&A picture, even more of a decline over the last few years, not even a rebound in 2021. China's M&A activity is really just continuously coming down, with, according to Bloomberg, number 24 billion in Chinese outbound M&A activity for the whole of the world in 2022, and a decline of about 20%. As well. So, you know, a pretty low year overall, to do once again with the global conditions, slowing growth, uncertainty, but also with a few very China-specific factors, of course. The economic situation in China, we had 3% growth in China last year, remember, on the back of very, very strict and drastic COVID measures and restrictions, which by the end of the year got lifted, but of course affected the economy throughout the year, and also affected just Chinese companies and investors' ability to travel, ability to just think through M&A deals or outbound investment. So that was a big factor, of course. And then a general context also in China of the tech crackdown, which really put a whole lot of uncertainty on a number of typical outbound investors. Tencent has been a very big investor in Europe and globally over the past few years, and the uncertainty that hung over some of those players' head the past 18 months has probably been contributing to this threat as well. So wanted to put this in the broader context now. What about Europe? If we go to the next slide, what we see is that the trend is pretty similar, right? We're on a downward trend overall, a little bit of a rebound in 2021, and then we have a drop again in 2022. And the drop in 2022 of about 22% gets us to what is a new decade low in Chinese investment in Europe of about 8 billion euros in investment. It's interesting to comment on the year-on-year picture comparing to last year, but it's almost useless in a context where Chinese investment in Europe is now just at very low level. And so from one year to the other, one single transaction can really bump things up or bring them down. And the rebound in 2021 was really linked to one single acquisition, Hill House Capital's acquisition of some of Philips's white good assets. But overall, and really the key message to drive home here is that over the past 5 years, and especially the last 3 years, we've now entered a new era of Chinese investment in Europe, which is a low-level era, where Chinese investments in Europe are just extremely, extremely depressed at a very, very low level. We're now about 83% below the 2016 peak. So this is to just explain how much of a drop we've been seeing. A lot of that has had to do with factors in China, tight capital controls, tightening capital controls around 27, which really caused that decelerating trend and that drop, but also a deleveraging campaign that's just made it much harder for China's investors to get the money they needed to do big splashy overseas deals. And as a matter of fact, and if we get to the next slide, one of the key drivers of this decline in Chinese investment in Europe is really M&A, and the fact that China's M&A activity in Europe has continued to collapse in 2022, and very much so continuously over the past 6-7 years. We are now at a level in terms of volumes of investment in millions of euro that is 7% of the 2016 high for M&A activity, and the number of deals is about 20% of what it was at the height of 2016. So really, when we're speaking about a drop in Chinese investment in Europe, we're speaking about a collapse in M&A activity, which was really what was kind of keeping the 2016 number high. And that's a major development. Once again, part of this this is capital controls and financial conditions in China. Part of it, of course, and we're going to get to that in a minute, is slightly more scrutiny on the part of European member states around M&A activity and big acquisitions in certain sensitive sectors on the part of Europe. Now, in a very mathematical way, the fact that M&A activity dropped means that the proportion of greenfield investments has been increasing. And so if we get to the next slide, I think the big story for this year is really the fact that the blue bar that had been so thin and small over the past decade is now the big story in Chinese investment in Europe. We finally, and for the first year since 2011, have greenfield investment making up more than half of the total of all Chinese investment in Europe, 57%. That part of the equation is still growing. We had more than 50% growth in greenfield investment activity, Chinese greenfield investment activity in Europe in 2022 compared to 2021. That's still concentrated across and over a few, just a few deals in the ICT sector, but especially in the EV sector. And this as well, we're going to dive into a little bit more in a minute. But really now, the main channel for Chinese investment in Europe has become greenfield investment. And so that's a key and very, very groundbreaking trend in the picture, especially in a context where for years and years, critics of Chinese investment in Europe focused on the fact that most of it was driven by M&A, and most of it was driven by this urge to acquire European assets without necessarily creating economic activity on the ground. And so now we're in a new configuration here where we're seeing a lot of manufacturing plants, especially in battery, being set up. So that's the very high level picture. Now I'm going to pass it on to Max to just give you a little bit more granular detail on the composition of Chinese investment last year.
Thanks, Agatha. And yeah, I'd like to start with I think one of the key takeaways that Agatha already hinted at, that we're at very low levels. And in general, and I'll reflect this in the next slides, it's also a story of concentration. So if we look at the example of the types of investors or the number of investors that have been driving the current trends in China, you have the top 5 companies accounting for over 70%. So this is the red line that shows you the share of the top 5 companies. That's a 18-point increase over the past 5 years. So this then also reflects that you have single deals really driving the current investment trends, which makes any predictions also very, very difficult. But we'll try to delve into some of these details here. And staying with the story in terms of concentration is also reflected if we look at the regional breakdown. So in 2022, you have 88% of the investment going to 4 countries. And it's a pretty typical pattern that we've seen also in the past years, is that you have basically the big 3 countries. So that's UK, Germany, and France, plus X. And X is usually another country that is driven by a single deal. If you look at the left slide that shows you the red bar is the big 3. Of course, you have some variation, but it's relatively stable, consistently above 50%. 2021 was an outlier here, and that is reflected to this one single deal that Agatha already pointed out. So this is the Hill House Capital takeover of the Philips domestic appliance division in the Netherlands. And that then also led to an increase of investment in the Benelux countries. So you had a similar deal this year driving the additional country was CATL's investment in Hungary that made Hungary a major destination. So the main story is here that you have this high level of concentration of these big 3, and you don't have any other consistent trend of other countries within Europe. And that's also reflected in where the cumulative investments have been going. So this is the map. You have the UK being kind of in a league of its own, followed by Germany and France. And then already gets very scarce. And a lot of these investments are usually, again, highly concentrated, and you don't have a really change in the aggregate picture here. And again, dwelling in at the regional breakdown and transitioning to the type of investments by ownership is also reflected in the high concentration of SOEs in the south. So the south is, well, Spain, Portugal, Greece, and the like that we bundle here together. And this is something that is now entirely dominated by SOE activity. So if you see in 2022, it's 100% of the investment going to the south. Again, a story of concentration. These are basically 2 deals by 3 gorges in Spain in new energy, so in solar and wind energy that are driving these investments. So this has become very focused. And if we remind ourselves on the discussions we've had in the past, with starting with ports and the like, so the story is kind of transitioning, but it's becoming a much more concentrated one. And if you look at the right-hand side and follow the red columns, the SOE story is basically a non-story anymore. So it's fallen to really extremely low levels. The EU investment, Chinese investments in the EU are clearly driven by private companies. And that has also to do with the sectors in which private companies are investing. These are sectors where SOEs are not very strong. So this is particularly would be in infrastructure and the like, but you have the growth story happening outside of these infrastructure-led investments and moving into sectors where Chinese companies are basically have 2 things coming together. They've become quite competitive, and there's an urge to begin their globalization strategy. And if we look into these sectors here, you have this drop in the infrastructure, in real estate, in finance and energy, so the sectors that will be very strong SOE activities, and you have this increase in consumer-oriented sectors that Agatha already pointed out. So, and this has often to do with large M&A activities by buying European brands, and that are, I think, a factor that we've seen continuously pop up over the past few years. And it's not to say that there is no longer a tech story to this, but it's become very niche. And they're usually smaller deals. So you had, for example, last year, this takeover in the medical equipment sectors, taking over of Wallaby, taking over Phoenix, but these are relatively small. So and it's difficult to organize them and make this very specific and concentrated. But in general, there are still these high-tech acquisitions, but I think the whole story has changed, and we'll dive into that about a little bit more in the outlook. And the main story here is really automotive, and here I'll hand over again to Agatha.
Thank you, Max. I think you've all understood that a key part of the story now of Chinese investment in Europe is investments in automotive, but especially in battery manufacturing plants. And so this is the red bar you're seeing growing and getting to as much as 53% of Chinese FDI in Europe in 2022. And in the report, we dive a little bit into this trend to try and put it in context again and explain how that fits not just within the story of Chinese investment in Europe, but really into the story of China's EV and battery sector, both at home and going global. There's probably no need to say and reiterate how vibrant and dynamic China's EV market and EV players and players within the EV value chain have been over the past decade, developing what is truly one of the leading markets globally for the EV sector. But we've seen over the past few years, and especially the past 5 years, those players in the EV value chain really going global and expanding their activities overseas. It's actually very telling that over the past 5 years, we've seen announced Chinese FDI in the EV value chain and EV value chain deals surge 40-fold, 40, over 2016, from what was about 600 million per year in 2017 to now 24 billion in 2022. So incredible increase, incredible surge in Chinese outbound investment in the EV value chain. And that is in the context, as I've explained earlier, of dropping or plateauing at least Chinese outbound investment. So this is the story of what's happening in terms of China going global at the moment. It is an EV globalization that one should have in mind. So much so that EV-related deals have represented as much as 20% of China's outbound FDI over the past 5 years, and as much as 60% of Chinese outbound investment in 2022. So an extreme concentration and very, very strong interest there over the past few years. What's interesting here, and on this graph, just to say one word about it, is that the focus has shifted a little bit. In the early years, the focus was really on mineral deals. So companies in different segments of the value chain really investing in Indonesia and DRC and the likes in mineral resources, extraction, processing, to make sure that they had access to the inputs going into batteries and EVs. But we're seeing a change in focus over the past 5 years, with this, once again, dark blue bar growing, with batteries really now coming to the fore, and overseas manufacturing of batteries really picking up. And within this, Europe, if we go to the next slide, Max, please. Europe has really been a key player with, almost, a vast majority of China's outbound investment in EV last year going into European countries, Germany, France, Hungary in particular. And it's not a complete surprise. After all, the European EV market, European market for green tech in general, is an enormous market globally, one that is extremely fast growing, and has a little bit less of China's completely cutthroat competition, especially in battery making. And so there's a very, very strong pull factor here. The other factor is the fact that Chinese EV partners, European EV partners in China, are also locating manufacturing plants in Europe. And so there's a co-location, kind of natural co-location between European final assembly, final manufacturing plants and the battery makers that feed into those, and a very strong density, once again, because of the size of the European market in the EV sector. And finally, a European market that, of course, has been slightly more open than other key markets to Chinese investment over the past few years. So we're seeing a very, very strong pull factor here, so much so that Europe has been capturing, as I said, a majority of those battery deals over the past few years, 15 billion euros in Chinese investment in the EV and especially battery sectors over the past few years. And within and by 2030, those battery plants by Chinese companies could represent as much as 20% of Europe's output of battery production. So a very, very big deal here. The largest investors are CATL, Svolt, Envision, and Volvo as a ultimately Chinese-owned company for the car making part. The focus is still very much on battery modules and pack, but we're seeing some diversification in actually other segments of the value chain. And the key question maybe for next year or the following one will be whether we see an increase in final assembly and actual EV manufacturing plants picking up. We're seeing Volvo speaking about a plant in Slovakia. We're also seeing BYD scouting for opportunities in Europe. So it's absolutely possible that we could see a slightly different mix, but still very strong interest going forward. So I don't want to spoil Max's outlook discussion and kind of last comments, but I really wanted to just put this in focus, show how much of an interest there has been in the market, and we can discuss that in Q&A. To you, Max, for the last few words.
All right, thank you. Yes, so some of the points that will be driving the investment story this year, we've already touched upon, but I just want to, maybe zoom in on a few factors here and break them down into aspects that are happening in China, and then drivers that were happening in Europe. And first of all, I think we're already getting a clearer picture, basically, of the need to adjust our expectations of the Chinese rebound. I think a lot of There was a lot of hope in that with China reopening, that not only their economy will be surging ahead, but also that there will be a lot of maybe pent-up investment that will then go abroad. This is not really happening. And that has to do with the recovery in China being much more uneven. And you have companies basically licking their wounds to some extent and going and driving outbound investment in the not only the due to the economic situation, but also the changing geopolitical environment is not high on their priority list. So that's not to say that this is not going to happen, but it's going to be very not only sector specific, but also company specific. So and I think that's going to be a key determinant in looking how Chinese companies are going to be investing abroad. You have another aspect of, and Agatha pointed out that the tech sector companies have been a major driver also of investment activities. They're also adjusting to the new political economy, if I would say that, very neutral in China. And that's also going to have an impact. And if you just look at companies like Alibaba that have been split up, that takes away some of their firepower. So they do have to navigate this quite cautiously. And another, I think, quite important element is that there is also an element of, let's say, a shifting prioritization of even acquiring technology abroad. To some extent, that has to do with also screening taking place in Europe, and some of these have been, after deals have been taking place. So that also creates a certain uncertainty, or it creates uncertainty in acquiring tech assets abroad and then actually securing this on a sustainable level. So I think this is also shifting towards a larger interest in getting foreign companies with the necessary technology to actually invest in China, because that's considered a safer way to access this technology. So this in a nutshell. So I think we're going to see also more red carpet treatment of foreign companies that have this access. For Europe, I already touched upon this. You have the larger or extended of screening mechanisms taking place, and well, a certain unease in China taking over strategically relevant tech assets. So this is obviously not going to go away. We did a list of what you see on the right of deals that have been screened and what the outcome there has been. I mean, you can kind of get a pretty clear picture of where these screening takes place. A lot of it has to do with technology. You see semiconductor companies popping up, obviously, across Europe. So this is something that's just going to continue. On the other hand, you have this, you will have Europe's continued attractiveness for greenfield investment, and driven by the automotive sector. And I mean, also in terms of how the data is collected. So it's counted as when this you break down larger deals. So for example, if there's a 5 billion plant that is built, the money tickles in over a few years until the construction is completed and the plant is operational. So just that in itself will ensure that the greenfield story in automotive will be still relevant for the next few years. Yeah, we'll see how that then basically goes. And I think one of the biggest factors that will affect investment, and also the uncertainty that comes with it for Chinese investors, is that there is always the possibility of a very rapid deterioration of EU-China relations that could then affect, and I mean, even if there's just a prospect of a deterioration, that will affect an investment decision. So I don't think I have to name all the potential escalation ladders that are here, but you have obviously the geopolitical risks, but you also have outstanding responses to new legislation in the EU coming out that are potentially targeting Chinese interests. So if you just think about the International Procurement Instrument or the Critical Raw Material Act, that could affect investment decision. And maybe as three main takeaways that for our expectations in 2023 are that you should not expect a sustained return to the high levels in the mid 2010s. And I think the emphasis is here on sustained. As Agatha pointed out, you could have one single deal, for example, a takeover of some consumer brand that will drive up investments. But again, we're not very confident that this is going to be a sustainable trend, but more of a one-off. And given the low levels, you will always have the higher likelihood of such outliers that then impact the overall investment. I think it's going to be much more relevant that you will have these, or basically a distinction between the tech sector and the non-sensitive sector. So I think M&A deals, as we pointed out, and as already has happened in last year, are going to be smaller and targeted. So they're going to be targeting niche players in relevant sectors. That could be anything from medtech to railway to aviation to semiconductors. So companies that possess something that enables China to gain access to technology where they have a gap, or they lack the relevant knowledge, and maybe also sectors that are very hesitant to bring their R&D and higher value chains into China. So this is something that I think is going to continue. And let's say the beauty of this, if these are relatively smaller deals, they will become less noticeable than elsewhere. Now, we've seen also in last year that this is not always the case. There has been backlash, especially in semiconductor, but I think also semiconductor we have to treat a bit separately. That is an area of extreme heightened sensitivity. I think there's other areas relevant in the technology sectors that might be less affected by such smaller and targeted areas. The other issue is a focus on non-sensitive areas. So anything that has to do with consumer brands, have we seen, for example, or logistics potentially, at least if it's not harbors or ports and the like. But I think there's a number of non-sensitive sectors that are still going to be relatively open, where Chinese companies want to use also international brands and secure market access to the European market. And as for greenfield investment, as noted, this is an automotive story. And for this, even though we've seen this as a growing trend over the past years, for this to be a really sustainable trend, this will need to broaden the sectors that are affected, because at some point the automotive sector story is going to be, nearing its end. You have some impact, obviously, in the battery production. Potentially, you have Geely and Volvo looking at manufacturing vehicles. So that might still be a story for the next few years. But really, in order to be more sustainable, we'll have to see this venturing off into new sectors. And this could very much be anything related to green energy, where you also have a combination of Chinese Chinese companies being very competitive, but also changes in the European legislative landscape that will encourage Chinese investors to engage further in such activities in Europe. And I would leave it at that.
Thank you very much, both Max and Agatha, for this deep dive into into this study. And actually, I shared the link in the chat here for everyone who wants to dive even deeper after this session. I already have gathered a lot of questions here to both of you. So, quick takeaway: we have entered an era of low-level investment from China's side in Europe. And also what we see is an EV globalization that China seems to have strategically planned, and of which Europe also becomes a target. Actually, I have gotten several questions, Agatha and Max, on the question of greenfield investment. So one question actually would be one that I also have. What would be the other sectors that you think might be the target of greenfield investments as we move forward? Right now, it's quite focused, as you said, on batteries, automotive, but what lies ahead? And I don't know who wants to come in first. Maybe Agatha.
I'm happy to jump in. I think we've had that discussion with Max, so we tend to have the same point of view. I think in greenfield investment, a big trend had been ICT investment, especially in servers that would allow Chinese platform companies and digital companies to localize data in Europe to align with GDPR requirements. And so that trend is likely to continue a little bit, but we're seeing more and more scrutiny around ICT in general, and China's ICT players, TikTok among them, which was a big investor for a long while, ByteDance, the ultimate owner in Europe. And so that trend might actually reside a little bit and kind of come down a little bit. EV certainly likely to play within the EV value chain. We could see up and down movements in, as we say, manufacturing, but also different bits of the battery itself, kind of supply chain. And then possibly, this is a question mark, in the context of the Critical Raw Materials Act, maybe some Chinese player locating in Europe for processing or even mining, if at some point this becomes a real trend in Europe, and some of the member states kind of get beyond some of the environmental concerns, of course, around mining activities in Europe. So if that were to break open, there could be potential here. And then in the whole range of green tech sectors, we could also see a location for concerns over tariffs, over actions against Chinese kind of low price Chinese imports, especially solar panel, of course. And there's a very, very strong, of course, European policy within the NZIA, the Net Zero Industry Act, to try and reshore and bring back part of that manufacturing capacity in Europe. There's no condition in the NZIA that those investments should be European investment or European owned. And so there's a place for Chinese owned manufacturing of green tech within that context, that new context of a European quote unquote industrial policy for green tech. So solar panels, hydrogen, potentially also wind going forward. I think those are really the key sectors. Max, would you add anything to that list?
No, I think for manufacturing in greenfield investment, that's pretty much. I would be very much in line with that. I mean, there could maybe one aspect that you could also imagine is in terms of any type of investment that facilitates Chinese market access into Europe. So that could be also taking over warehouses or logistics. We've seen that in the past. So these are also issues we can see, but it's not going to be part of a bigger story. So I share your views.
If I may briefly take a step back, and maybe that's also something Gregor, Sebastian could come in on. There's a question regarding this focus on EV investments. And the question is, since China has a rather big competitive advantage in the field, at least it seems like this right now, how do you assess investments? Are they beneficial for the EU, or are they more risky? And I don't know if Gregor wants to come in on it. Oh, here you are.
Yeah, I can maybe start off, and then Max and Agatha can also chime in. I think first and foremost, this is a beneficial aspect, right? I mean, greenfield investment often is also regarded as more positive. It's bringing over jobs, investment. In the case of batteries, actually technology that at the moment European providers and even other East Asian competitors cannot provide, right? At the moment, China is really the only player, CATL and BYD in particular, that can commercialize LFP batteries. So that is actually quite good, I think, for Europe. Obviously, there is a concern that, you know, this can also hamper in the long term the emergence of a European branded battery supply chain, right? So if you have now Chinese producers coming in, that's going to increase the competition for European companies like Northvolt, for instance, right? But on the whole, right, also taking into consideration that we have a big car industry that really wants to electrify, taking into consideration our decarbonization goals, I think this is more or less a positive story.
Thank you, Gregor. And I think that pretty much answers the question. So thanks for that. One question pops up here, and I actually also had that question in mind. This focus on greenfield investment, is this a Chinese way of adapting to investment screening mechanisms? Maybe a question linked to that. Would you expect investment screenings also to affect greenfield investments at some point? And I don't even know if this isn't already the case. So maybe you can enlighten us. Agatha, please.
I'm happy to jump in. I think so. I don't see China's greenfield investment in Europe as adapting to screening mechanisms, because the rationale is different, right? The rationale for greenfield investment in Europe is just to have manufacturing capacity on the ground. When you're a battery maker, you absolutely want to have your factory next to the final assembly factory, because there's a lot of kind of tiny last-minute changes you need to make to your batteries, kind of some of the specifications that need to be changed, and it's much easier to do if you're close to your final client, right? And so much of that is really just motivated by the state of the market, the cost, the trade cost associated with shipping batteries versus making them on the ground, and then the ease of doing business if you're next to your final client. And so it's not the motivation. It's not an evasion of the screening. Greenfield investors, especially in EV, are not looking to acquire assets in Europe. They wouldn't necessarily be caught in FDI screening for that activity. They're actually bringing know-how, bringing technology, bringing IP that has somewhat weighed a little bit in Europe, and so it wouldn't necessarily. I don't see it as a strategy. By the way, Claudia, you mentioned in some of your comment the Chinese EV push as being strategically planned. I really want to take this apart actually and say this is a commercial push. Chinese EV makers just want to be global. They want to be global because the competition on their market is cutthroat. They want to be global because the market is global, because the market is in Europe, it's in the US, it's in Japan, it's in South Korea, it's in Southeast Asia for certain types of cars. And so, of course, there's a strategic push in China to develop EV, but to think about the outbound push as being strategic, I want to break that down. This is mostly commercial decisions to be where it matters and to be where it's most easy to do this. Now, I do want to mention that those greenfield investments in EV and in other sectors could be screened. They could be screened under two main regimes. They could be screened for inbound investment through inbound investment screening regimes. The 2019 EU regulation made that possible. Now, the question is whether member states within their own investment screening regulations and laws make that possible. But at the EU level, if you wanted as a government to screen greenfield for greenfield investment, you could screen for greenfield investment if you thought there was a national security reason for it. It's hard to find what it would be, but it could be an over concentration, of course, for example, of kind of battery manufacturing around Chinese players or something like this. So a question of resilience, maybe in the context of the NCIA. The second reason why those greenfield investment could be screened is for foreign subsidies within the foreign subsidies instrument. And there might be a case, there could be a case to say those EV battery makers are subsidized at home. They benefit from a whole lot of state support. They're coming to Europe and they're making batteries at a price that is, because of that, too advantageous, that is making it so much harder for European players to then emerge. So this is back to the question that Gregor was answering earlier. Whether we're going to see screening for those is a very big question, because this creates jobs, it creates economic activity, it creates know-how transfer and IP transfer, at least in the short run, and it creates a much easier, much safer value chain, supply chain for our own car manufacturers, that they don't have to source in China, but all of a sudden can source within European, from European located plants, which is also part of the European de-risking strategy, to say we need more globalized kind of sourcing opportunities. So yeah, just a few more comments on this.
Thank you.
Yeah, and I think the greenfield investments are in general going to be more resilient to any type of pushback that we see elsewhere. And I mean, this is not only a China story. We've had similar developments when Japanese and South Korean automotive companies became global, and there was, basically a pushback that then forced them to respond by increasing greenfield investment. So this is something similar that we also seen with Chinese car automotive or within the automotive value chain investments. But I mean, and again, coming back to the initial question in terms of if greenfield investment is a response to more screening and M&A activities. So I think just we need to also keep in mind that the overall greenfield investments were coming from very low levels here. So this is still a very fragile plant and very limited to basically two or three sectors where this is taking place, and even then on low levels. So this is we shouldn't expect Chinese investments now popping up any form of new plants across Europe, manufacturing everything here. This is not going to happen. And I think the most likely area are going to be, as Agatha pointed out, areas where Chinese companies have become very competitive. And you can debate about the domestic reasons about that, and this is probably going to be a debate we will have. But even if there's going to be response, you're going to be more reluctant to lose jobs, lose tax revenue. At least the local push will be bigger. And then there's always the question is when you're going to, especially if you talk about the emphasis on cutting or greening the economy, is the cost aspect. So yes, you can boost European competitors, but if you don't do it with Chinese competitors, your prices are going to be up. So that's also going to be a very complicated discussion. And that's only focusing on the economic aspects and not even dwelling into the geopolitical aspects of this.
Yeah, you're mentioning the word. Let's maybe touch upon the broader geopolitical context briefly. There's one question if Chinese investment in Europe could become an arena of growing transatlantic friction as we move forward. So Europe also becoming a backdoor for, I don't know, that's in parentheses here, for Chinese companies to access the US market, given that there's many controls and restrictions right now. What would be your take?
Well, I mean, I think we're making up a very big box here. There's a lot of reshuffling, readjustments taking place. And I mean, you have also Chinese companies responding differently to changes happening in the US and compared to Europe. I mean, at some point, I don't think that it's the Chinese logic and narrative to invest in greenfield in Europe to then access the US market. I don't think that's a main driver at the moment. So I don't know, Agatha, if you have other thoughts on that.
So my take on this is that on the topic of inbound investment and inbound investment screening, there's actually been a very, very strong alignment, transatlantic alignment and level of information sharing that actually dates back to the Trump years, where behind the trade war facade, a lot of cooperation has been happening and building up, and channels of communication, channels of joint work been building between Europe and the US on the issue of inbound investment. So I think unless there was a major transaction in the German port or in a transaction that was very clearly national security related and that was permitted for a very clear political purpose, there could be slight kind of high level friction and a questioning by the US of why that investment would be or would have been permitted. But I think at the working level, there's actually very little friction on inbound investment because there's a very high level of coordination. At the end of the day, we've seen in the past that the US is also able, through CFIUS and some level of extraterritoriality, to have a little bit of control on certain investments happening in Europe that they found to be problematic in the semiconductor sector as well. So there are also means for the US to drive a line that works with them. I think the tension and the friction is, of course, around industrial policy packages, the IRA, and the fact that those are diverging. Those have created intense friction between European large member states and the US. And here you see a really big kind of divergence in approach, where you have a really China-free EV policy mix in the US, which is absolutely not the case in Europe. And so rather than driving transatlantic divides, I think it could create a very suboptimal value chain organization. That's the main concern here. But no, not a lot there. We haven't spoken about outbound investment screening yet, but that could be one topic of not so much friction, but certainly very, very strong discussion going forward.
So you're talking about the US Inflation Reduction Act, right? I don't know if everyone, Agatha, knows.
Oh, sorry. Yeah, the IRA, yeah, exactly. Inflation Reduction Act.
A sort of subsidy program of the US to kind of inspire also European companies to localize to the US, which also is an area of tensions between the US and Europe right now. Would you, I don't know, is there a possibility of Europe opening up more again towards China because of these movements in the US? How would you assess that?
Well, what do you mean with opening up more? I think in comparison, Europe is still relatively open, and that's what we're seeing at the moment. So these, I mean, Agatha already pointed out some of the detailed differences in legislation, and this is also one of the messages we've tried to bring across in the report, is that Europe remains comparatively open and a still very attractive market. And this is something that, I mean, we shouldn't, we also need to be mindful of, putting all Chinese companies in one bag. They're also navigating very difficult, changing, dynamic environments, not only economically, but also the geopolitics of things. But there's still plenty of companies that have commercial incentive to try to bring their companies forward, and not everybody's following a master plan that is laid out in Zhongnanhai. So I think if you break it down to this aspect, I think Europe is still very open, and we emphasize that also there is a commercial incentive for Chinese companies to make these type of investment decisions in China. So I think we need to break away from I think a very old mindset in Chinese investment being SOEs and tech M&As. This landscape has changed, and let's say if the world were a simpler one, not only in China, but also worldwide, you'd probably have even more incentive for Chinese companies exploiting the commercial activities, because you're really at a phase where you have Chinese companies that are able and capable and are willing to have this globalization drive and go out. And this is something we've seen in other countries in East Asia once they moved up the value chain and then became global. So this is now happening at a very complicated time for Chinese companies. And again, Europe does provide still a very attractive alternative here, or a way forward.
But to Claudia's fair question, the IRA did pour oil on the fire of the transatlantic relationship, and I think the key example here is my own president, who very clearly leaned into China on his China trip, made comments that ruffled a whole lot of feathers, transatlantically, certainly in Europe as well, that were, for a big part, probably driven by certain US decisions, including the IRA, including the CHIPS Act, including AUKUS, that have had a tearing effect on transatlantic relations. At the working level, there's much more kind of alignment, coordination, and co-movement, despite Europe sometimes being a little bit behind, or a little bit more nuanced and constructive in the way that it does some of those China policies. But certainly at the high level, kind of political level, that's caused a lot of discontent. The IRA was a big shock to transatlantic ties.
Yeah, thanks, Agatha. And yeah, I was not. Yeah, thanks. Let's maybe, because we only have 5 minutes left, this could be an in-depth discussion. I was actually not referring to Europe, I don't know, becoming less attractive or less open, but investment screening. So that the political discussion sometimes just suggests that this is not so attractive after all for Chinese actors to be active in Europe anymore. But as you rightfully pointed out, there is a big commercial interest, and that apparently trumps all discussions on investment screenings and whatever instruments you would put up to protect your economy. Let's maybe take a peek into the future. There's one question, what your prediction for the following 5 years about Chinese investment would be. Now, that's a tough one, but maybe you could give us a sort of an estimate where you see that moving.
I think Max's outlook discussion was relevant here. The key takeaway really is that we're in a new era of really low Chinese investment in Europe. This is suboptimal in a normal world, non-geopolitical world, in a world where China didn't have capital controls, in a world where China wasn't in a de-risking phase for its financial sector. We would see 10 times, potentially 20 times this. The drive and the reasons for greater financial and especially investment integration between China and Europe are very, very strong. The problem at the moment is we've got very core and very heavy regulatory and other constraints on Chinese outbound investment. And just to restate them once again, I mean, capital controls in China are very tight at the moment, making it really hard to do very big investments, especially in sectors that are deemed more speculative, even if they would make sense. So real estate and entertainment and things like this. And so you've got a pressure on certain Chinese investors who are not able to do as much M&A, global M&A as they would. A restriction around just the financing of those deals, which in China is growing bigger by the day, with financial system getting more constrained. And then in Europe, of course, more scrutiny. But I think in truly, even with the level of scrutiny we're seeing in Europe at the moment, we could see 10 times the amount of Chinese investment in Europe in absolutely non-sensitive sectors. So most of the trend really comes from this constraint on the Chinese side, because I think non-politically sensitive investments in Europe would and could be much, much higher than they are today. Will that happen? Do we think this will be the case next year? Probably not. We could see 1 or 2 big deals above 1 billion, because we're at such a low level. Even if you had 2 billion deals, that would bump up the number, right? So you could claim that there was a rebound, but the story is low investment. Greenfield likely to stay strong. Also because the way that we count greenfield is that we don't count announced investment. We break it down over the years that it's going to be dispersed, and so we kind of have a natural lag period of 4 or 5 years, depending on how long those plans take to be built up. So we're going to see that in the number in the next 3 or 4 years. We can already tell you that, and there's so much more that could be done in greenfield as well. But we're going to see if on the Chinese side the restrictions can be loosened up, or if investors get a little bit more confident on the European side, whether scrutiny grows also around greenfield investments. As we said, we don't think so. And we think that greenfield is still going to remain a pretty decently safe area, especially in green tech, because Europe wants to pull a lot of that IP and knowledge into Europe. On the M&A side, potentially a little bit more fraught, especially if the sectors touch on sensitive sectors.
Yeah, I think if we look at the next 5 years, the key point will be, doesn't matter what the annual figure will be, given the size of the Chinese economy and its level of development, it will be under potential. So I think that will be kind of the key development for the next 5 years.
So no new era of record investment ahead for the time being. Yeah. We have almost reached the end of our session. I could give you a 1-minute chance to briefly touch upon the discussion that's ongoing in Europe right now about outbound investment screenings. Will this come? So investments from Europe to China, sensitive in nature. Do you think this will happen?
I think the debate will grow, and it will grow strongly. It will grow because it is growing in the US, but also because of European factors. At some point, what Max was saying is that a lot of the IP transfer and tech transfer that's happening now is not happening through Chinese M&A in Europe. It's actually happening through European companies investing in China, and that's just a matter of fact. And that has to do with, all of the right incentives and some wrong incentive, but mostly right incentives to be doing R&D and IP sharing in China at the moment. Now, if you are screening for inbound investment in certain technologies that you deem to be sensitive, there is a case and there is a question about whether you would or might want to be screening for the same outbound. If what you're trying to do and aiming to do is to limit the transfer of core dual use or military relevant technologies, then of course you might want to see what's happening on the ground in China. But the debate will grow is the only thing we can say, and I think we're going to see a lot of it in 2023. We saw it in the G7, mentioned in the G7 not takeaways statements, and that's a big deal at the end of the day, because some of the G7 member states weren't really on board with this. So for it to make it to the statement was a big signal.
Yeah, I agree that the debate will accelerate when it comes to outbound investment, but there's also going to be tremendous resistance for companies that, especially in northern parts of Europe, that already struggled with investment or inbound screening or strengthening inbound investment. But I think there's another aspect that we need to keep in mind that might not be de facto outbound screening, but it will be tighter scrutiny by financial markets and how they assess these type of investments in China, given the risks that they might expose their companies towards. So I think there's going to be, it's not only going to be the legislative push, which will be much more difficult, but there's going to be much more scrutiny from financial markets that can affect, not only pressure depending on how stakeholders and ownership, but also in terms of how the cost of capital will change, reflecting the new reality. So I think this is going to be also a multifaceted approach that will force companies to rethink their investment pattern beyond legislative changes of restricting outbound investment.
Thank you both. So lots of discussions to be expected on outbound investment screenings. You guys will continue to look at China's inbound investments in Europe. Next report is, I guess, already in research. So thank you so far for presenting us the update 2022, Max and Agatha, and also to Gregor for chipping in. Thank you all in the audience for your great questions. We have reached the end of the session, and to the very last question, whether we could share the slide deck, we could do that, but you will find all the slides in the study. So what I would suggest is you just download the PDF on our or on Rhodium Group's website. That said, thank you all for being here today and hope to see you again soon. Have a great day.
Thanks everyone for being here.
Thank you. Bye-bye.